Today we're going to be going over the box, the basic pattern. Stay tuned, traders. We'll be right back. Good day, traders. I'm Stacey Burke from Stacey Burke Trading. Some absolutely huge moves yesterday on gold, the euro, and the pound, all giving off great trades. A lot of emails from traders that have been locking in pips. We're going to talk about the basic pattern again today. The box, price is in a box. We're going to talk about understanding the timing window, putting a high or a low in place, then either working that extreme for a reversal or putting a high and a low in place, and then watching into the next session if the market expands that range or if indeed we're in a trend trade. We talk about the three things that markets do: trend trades, reversal trades, and trading ranges. Before we get into that though, again, thank you for a ton of great feedback, a lot of emails, a lot of great results. A few traders having some challenges. We're going to get into some more of that in the coming videos about overcoming some self-sabotaging habits, repeating losing cycles, ways to improve that self-sabotaging behavior and changing those habits. But again, before we get started, take a second for me and hit that like button. Again, turn on your notifications so that you're getting updates when the new videos come out. I know a lot of the material has helped a lot of traders and a lot of new traders coming on board, and repetition, repetition, repetition. Master the basics. It's as simple or complicated as you want to make it. So let's get into it. Just to review our timing window: Asia, 8 to 11 p.m., London, 2 to 5 a.m., New York, 8 to 11 a.m. Now, we're going to, in a couple of the coming videos, go and talk about the 4-hour cycles a little bit more in depth outside of that timing window. But for now, the most important time is this 3-hour window. Now, when the day starts, we roll over from New York. Chances are we've got a previous day's high, a previous day's low, regardless of the instrument, regardless of the pair that you're trading: index, Bitcoin, Aussie dollar, gold, pound yen, doesn't matter. We have a high, we have a low. How do we define that? Peak formations. So a lot of questions about what is a peak formation. Now we're going to look at some examples. A peak formation for me is an engulfment of a structure. There's lots of different formations that can create an engulfment. We can get a 2-bar reversal that doesn't completely engulf, but it is an engulfment on a smaller time frame. We can get a pin bar that's engulfed. An engulfment is a bar that completely closes below a high bull or above a low bear. Now, there are some subtle tricks that the market will use to trap traders thinking that there's an engulfment. We'll look at some examples of those. But the market, in that first 3 hours, it may start down here and it may go, for the new day, it may start here and go up. And over the course of that 3 hours, establish a high and a low. Now that may have moved right up for 3 hours. When we get into the gap time, we may have a high in place and a low in place. They may stay inside for the remainder until the next 12-candle window. So again, coming back to the premise of understanding that we are in a box. Now, the other scenario is that before we get to our next 12-candle window, the market may pull back and continue to go higher before we get into our new 12-candle window. So the market may come down as we head into the London Open, or the Europe-London 12-candle window, which again, now we know there's a high. The market has expanded the range. And I've talked about taking these trades back to the high for a stop hunt trade. And typically, in most cases, that will be a range of at least 25 pips. At which point now we can hypothesize that now London may be putting in a high of the day. So again, we may get a high and a higher high. But our initial box that we had in this particular situation is making new highs. So our high now may be up here. The market may go up a third time before coming back inside, retesting and rolling over. Our high of the day is in place. We obviously have a peak formation that's above that high, but for our box is here. Okay, we know there are stops there, but now our first target is going to be where that move originated, which is also now a breakout of our first level of rise. 1 push, 2 push, 3 pushes, 1, 2, 3. We get our M formation for our reversal. The market may come down and it may stay inside now, or it may continue to come back down towards the low of the day. Understanding though still, we are in a box. The market has made a high, a higher high, a higher high, and then tried to break out and reversed, retested underneath and rolled over. We've expanded the range up top. So we got our peak formation up top. The market now will come down and test the low of the day, at which point it may work in 3 pushes into our next 12 candle window. So again, our gap time, we may expand that range even lower, or they may pull back inside. So as we head into our New York session, our low may be here, our high of the day is up here, but we may, before the session starts, end up retesting down into the low of the day. We have stops above here. So again, understanding we are in a box, we're in a big box. Now we've triggered the previous day's high, the previous day's low, maybe down here. This market may come down and break out and roll over, or we may jam into this low and reverse. But again, understanding we're in a box. One of the problems with using indicators is that these indicators will get traders following these moves up into the peak formations, and by the time they reverse and they're coming down, the same thing can occur in the other direction. So coming back to our simple understanding that price is in a box, we may end up going up and we may end up coming down, but eventually the market will either break out and trend, or it will break out and reverse and go to the other side, or it will break out and just trade back and forth inside of this range. Now, day 0, the basic pattern to me are essentially almost the same thing every day. So what do I mean by that? Okay, so if my basic idea of the box, a day 0 is when we get a day that is a fairly narrow range day where the market locks in a high and it locks in a low, and for the most part, for all 3 sessions, it stays in that narrow range. It could be 100 pips, it could be 50 pips. So we have a peak formation high, a peak formation low. It's a narrow range day, and typically it may be an inside bar, but at some point, as we've hit stops, the market usually will coil out and become a trend day, whether that's up, whether that's down. This coil, this narrow range day, typically is where we get coiled volume. So again, our basic pattern is hit the stops, and trend. And again, that could be either way, okay? But if we get a day where we're making new highs, essentially, we are getting the same thing. We'll get the same sort of scenario. We have a box in one direction, okay? That same pattern will occur. We can get a trend day where the market blows off in the direction of the trend. So we talk about our extended M's, we talk about our shortened M's, and we have our normal M's. So understanding that if our basic pattern has a high and a low, this could be Asia. Okay, London may go and make a higher high. Okay, and typically, as we've said, most stop hunts are 25 to 50 pips above or below the range. This may be to a quarter level or 50, 75, or double zeros. Major round numbers, 50s and zeros, are typically where I'll look for a move to end. We saw this on the pound and the euro yesterday. So London, therefore, will either be in the middle of that move because our box now is making new highs, or they've expanded our box, our range, and the US will come back to retest the bottom of the box. Now they may come back to the box and come back inside to close the session, or they may break out of the box and expand the range on the south side. So when people talk about trends, or we talk about, trend lines and wedges and all these different things, when the day starts, we have a high and a low. And we're either going to be breaking out and trending, okay, we're going to be continuing to make new highs. And how do we know if we're in a trend? Our timing window will tell us this. If we're not in a trend, if we're making new highs, we'll be trading into, again, if we've had a previous day's high, we talk about nobody getting a free lunch, but we'll be either at some point, the timing window over that 3 hours for London, the Europe-London session, will have either put in peak formations or they will have traded and the market will continue to trend strongly. Now, typically, we don't get a trend day every single day. We'll normally have one good trend day a week, and the other days are essentially, again, we talk about our weekly template, day 1, day 2, day 3. We might get 3 peaks before the market reverses. We could get day 1, day 2, day 3, and we can get a reset and come back for another day 1, day 2, day 3, and in the same direction for a 2-week trend. But this day 0 effect basically happens every day in some form, whether it's peaks to roll over. Again, the 3 things markets do. If it's a trend day, it'll just keep going higher and higher or lower and lower, or we'll be inside and the market will break out and fail and come back to the other side of the box. And again, the same thing applies for the other side. Sometimes the market will break out, put in a higher rectangle, break out, and we have now a measured move possibility going back in the other direction. The same thing applies in the up direction. So the day 0, the basic pattern is understanding that we have a high and a low that will be established typically as the day starts. Now again, I don't care what anybody says, the day starts in Asia, London's in the middle, and New York closes it out. So over the course of our 3 sessions, we're either going to have a trend, okay, or we're going to go up and reverse, or we could go up for 3 sessions and reverse in New York, or we could be, again, the same thing on the downside. London, New York, all those sort of scenarios. But the day starts with a high and a low from the previous day, and as Asia starts to trade, it will put in both of those prior to heading into the Europe-London 12 candle window. And then we either expand the range, stay inside for a day 0 or a narrow range day. Okay, we can expand it on both sides, and the market will then either trend in one of those directions or stay consolidated or work one side. Okay, we can work one side and continue in the next session, or reverse inside and go back to the other side. We can expand on one side, reverse to the other. We can expand on both sides and come back inside and consolidate, but we're in a box, the basic pattern. Let's take a look at some of the examples from yesterday on gold, the euro, and the pound. Again, thanks for a ton of great feedback. It's Friday. Let's end the week on a strong note. Some huge moves this week, and I think it's just going to continue. We're at a tipping point with a lot of the markets. A lot of traders knocked it out of yesterday on gold and the pound. Keep it simple, traders. Keep getting better. Highs and lows. Work from the extremes in the timing window. Engulfments, high bulls, low bears, round numbers. Have a great trading session, and may the markets go with you.
Today talking about the basic pattern, the day zero pattern, the box, and we're looking at gold from yesterday. We're going to look at the pound and the euro, keeping things as simple as possible. Heading into the beginning of the day, we have the previous day's high. We have a swing low that now locks in a low of the day. So again, understanding that this is our most recent high, the engulfment now, understanding that we have the high bull candle closed below by these bars, creating a locked-in high, regardless of where it's at. We have a bar, a 1, 2, 3 that's closed below, locking in a high, and then we also have a reversal of a low bear being locked in, giving us a low. So we have a high and a low as we head into the next day. And now we also obviously have as the day begins, a low of the day, of the current day, and we have a high of the day in our first hour. Now, yesterday, as I mentioned, I took this trade on the 1 minute with the premise that this market would have a second day follow through to the high of the day, because we know there are traders on not only the 15 minute, but the 1 minute, the 5 minute, whatever, that are short, and the 15 minute that are short that have stops. And my premise and the setup was there to give me a trade entry long right off the bat. And we also had a 15-minute W also to take out the high. So we have the high of our box. We have our low of our box. So we have a peak formation high, peak formation low. The market then proceeds in our 3-hour window to expand the range higher. It breaks through, makes a new high. We have an engulfment. So again, understanding we're in a breakout, the market engulfs, trapping traders short at the high of the day. And again, understanding we're already in an existing up move. The market then proceeds to come for a third push. So we have one push, two pushes, and then a 1, 2, 3. So when you have pins above and you're enticed to take this on a second push, we know there are stops above this candle, above 25. The market is going to expand the range, potentially at least up to 50. We come back 1, 2, 3, and again, understanding the timing window, this first bar down is the beginning of an hour. So again, breakout, pullback, retest of the high. We come up 1, 2, 3. And on the 1 minute, there was a beautiful engulfment right at the high at the end of our 12 candle window, which ended up being the high of the day. But focusing on understanding the box, they've expanded the high of the box, pulled it back inside, and then continued to retest that high 1, 2, 3 before engulfing. Now, this engulfment comes back inside, taking out the lows of traders who followed that second leg up, hitting stops, but understanding that we are back inside of the box. The initial box that we started with, they expanded the range, pulled it back. They went back a third time, 1, 2, 3 hit stops, but they pulled it back inside. Most stop hunts on average are 25 to 50 pips. If this was a trend trade, this would not have pulled back. It would have came back and retested the breakout and continued in the gap time to work back towards or above the high of the box. Now, it could potentially stay inside of the box and still trend. But in our gap time, as we head into our Europe-London 12 candle window, they come back and they pin up through the high of the box into traders that are short, pull it back. Our 12 candle window starts. We get 1, 2, sideways for 3 bars, 45 minutes with 3 pins above the high of the box. So our box is from the previous day's close, the previous day's high, peak formation high, peak formation low. This is the bottom of the box. They're working the high of the box. They went outside 25 to 50 pips. They pulled it back inside. They are now working the high of the box. They come back a second time, giving us a middle structure, 3 pins and a bear pin hammer at the London Open. So again, the second hour, I know London's not gone back to daylight saving time yet, but the second hour, again, to me, the algorithm has not changed. It is still behaving as it normally would, regardless of London not opening for another hour. And then we have the huge move down to the low. Understanding also that all of this volume above 75, everything up above there, is all trapped. They're all trapped. When the market breaks down like this, it is not coming back. If it comes back, it allows all these losing traders who are now either stopped out or getting margined out to get out with either a smaller loss or with no loss at break even. We've gone up, made a high and a low, and then they've proceeded to work the high. They hit stops above the box, 25 to 50 pips. They pull it back inside. They work the high. They drop it down and fade all the way down to the previous day's low. So again, we come down to the low. We get an engulfment in the U.S. session after stops have been hit. We get the engulfment, the retest of the low on the smaller time frame traders who are in at the extremes. There's a 1 minute reversal at the very bottom at round numbers, again double zeros after stops have been hit. They triggered end of day traders long, 4 hour, 1 hour, 15 minute traders triggered long at the open of the second hour. Come all the way back down, they fade down, they hit the stops on the bottom. So anybody who's long on the top end of day may have had their stop at the previous day's low. All the Fed trades, everybody who was up all this profit, if they didn't lock anything in, they're stopped out. There's the round the world, the popcorn trade all the way back. Pin hammer, and then the pullback inside. Now coming into today, we had a 3-bar 1, 2, 3 peak formation put in place. Not a textbook perfect situation, but again, you can see a 1-bar blow off. Then we had a high bear engulfed, even though it was inside of a large bull. Again, we attract a long trade into the market. We engulf the low bear, which is also the engulfment of the doji. So we have traders who are long into this peak formation. We know there are stops down below the doji. We had 1 push, 2 pushes into the peak formation, into the top of our box. We have a high, we have a low, and then a 3rd push into the beginning of the day, and then we get our engulfment bear pin hammer at the end of the first hour, the engulfment of the high bull candle. So heading into this session, we had a textbook perfect 1-bar engulfment on the 1 minute right at the open, a first bar trade for the short trade all the way back down to hit stops on traders that were long up top in the rectangle. We had a box, an upper box. They worked it in 3 pushes, 1 push, 2 pushes, and a 1, 2, 3 engulfment first hour, a bear pin hammer at the second candle of the second hour, and then the 1-bar engulfment on the 1 minute right at the open for the 50 pip trade down to the low of that box. So again, just focusing and understanding prices in a box. So now we have a high of the day. Okay, we have high of Asia, but we also have a high of the day. And then the market proceeded to, we have our high, our swing high for Asia. Then the market proceeded to come down and give us a low of the day. And then the retest of the low. The stop hunt back up inside of our little W formation. So we have our low now and our high, and how the market behaves from here will dictate whether we are looking at a trend trade outside of the box or a retest of the low for a move back up. But we're inside of the high and low currently, so we wait. The pound yesterday was a almost textbook perfect example of, again, a horizontal rectangle, the master pattern. Initially, they triggered end-of-day traders right off the bat, hitting the previous day's high after the Fed blow off. But again, most importantly, the Asian session put in a high, and we had a low of the day in place, which they proceeded to work down into, expanding that range before engulfing the low bear candle. So we had the inside bar, then the engulfment in the gap time. So coming into the session, we're inside, but the move was on its way back to the peak formation of the Asian high. So we've expanded the range on the bottom. They go up to round numbers, 1, 2, 3 out of the high, and the engulfment of the peak structure. So again, I'm emphasizing anytime you get a large candle engulfing like this, you can rest assured there will be a retest, and nobody gets a free lunch. And understanding that if you chase price, that's fine, but you're taking on a lot more risk than necessary. This is a 15-minute chart, but understanding the high and the low, they expand the range, pull it back inside. They expand the range, they hit the stops on the upside, they pull it back inside. So you're inside now. So if you're in this short trade, 1 push, 2 pushes, 3 pushes, take your money, or be getting out at numbers. This market came down from double zeros. 50 would be the first target. There's no middle structure. This market has no reason to go all the way straight down to the other side. If it had 3 pushes, then potentially we have a middle structure for a measured move. But again, essentially, it's just expanded the range, and pulled back inside into consolidation within a 25 pip box. 1 push, 2 push, 3 pushes. And then our gap time stop hunt, 1, 2, 3, pinning into traders that are short from the peak formation. And again, on a shorter time frame, this is reaching up to get heat on traders who are short somewhere up in that initial area rate from double zeros. We get our pin bar to the high. Then we get our little bear structure inside of that peak formation, triggering the shorts. This little lower high, lower low before it pulls back, and then boom, it blows off and goes straight down to the low. So again, we have these higher lows inside of the box now, which gives us low-hanging fruit to target to get to break even. The close below this first higher low is our break even point, and our thesis is that this market should move quickly once this volume is trapped underwater. So once this candle closes, all of this volume is now trapped. It should proceed straight through to hit stops. And again, a move like this, just taking a high-low measured move, we can go for 1 full expansion. If the market is behaving as it should, if it got down to the low and hesitated, again, we see the 1 bar pullback, but we're underneath a 50. So understanding the numbers, 0 to 0, they break through 50 to hit stops. They pull back underneath, which is a retest, and then continue down to the double zeros. So we're in a box, 25 pip box. They push up, they hit stops on the bottom, they push up to the double zeros, they come back inside, they retest the breakout of the short trade, and then retest the bottom of the 100 pip box. Double zero to double zero. And again, today, just looking at the same principles, they've locked in 50 heading into the new day. Okay, they locked in double zeros at the U.S. session. The market is a creeping trend down in Asia, hitting the low, pulling back inside, respecting the double zeros. And at this stage, this double zero box has held. We have lower highs, which could be low-hanging fruit heading into the next 12 candle window. We'll either retest the bottom of that double zero box or potentially break above that quarter level and retest the highs of the day and 50, which again could mean if this market stays in a 50 pip box or break above 50 and retest yesterday's highs. Now the euro was, I think, again a textbook example, high and low set in Asia. initially the day starts, we trade into the previous day's high. It's in consolidation before they get an engulfment and give us a high of the day in place. Hitting stops on the higher lows and breaking down, expanding the range on the downside before engulfing the small doji, as well as pulling back and then a bullpen hammer, which engulfs our other low bear, putting a low of the day in place. Again, this is all price action prior to us coming to the screen, so this is not hindsight or anything else. I don't trade the euro in Asia or the pound in Asia. Not to say that it can't be. I don't. The point I'm trying to emphasize is that they gave us a high, they gave us a low. As we come into our Europe-London 12-candle window, the market works its way back up to the high and then is engulfed in the second candle of our middle hour, which I typically would say is the London hour, but I know that people will get all upset and email me that London's not open until an hour later now, and anyways, it's the middle hour. It's an engulfment. And as I mentioned, in most cases, the market does not give a free lunch on a large engulfment like this, but in this particular case, the market fell straight through to the low, in which case this market gave us a second opportunity to enter the market after a 1, 2, 3 into the low of the day at 50. We have pushed up towards the double zeros, not been able to get there. We've pushed into the previous day's high. We've broken out of our box. So I take my measuring tool and I look at one full expansion as a minimum target if I was to enter this trade. At that point, I would be looking to be at break even and then monitoring how that trade has progressed, if it was strong, if it took off right away, if it's a creeping trend, if it's struggling, if it gets to the bottom of this box. This just may be the area where I may need to lock in profits. It breaks through the bottom of this box. So again, our understanding, people say, where did you get in? If I did not trade this. Those trades on gold I did take. I did not trade this on the euro, but again, understanding the 1, 2, 3 engulfment at 50 gave traders two opportunities. One, to enter in on the close, or to wait and fight for a better fill, or to do both, partial and partial. If you get the better fill, either way, you're in the trade. It's a 1-bar stop at the high of that bear candle. That's the engulfment. And then our premise is that, again, there's two theories. One, full expansion of our high-low box, but also I could take two expansions of this high-low 1, 2, 3 to the engulfment candle, which gives me somewhere in the area just a bit further past, and again, monitoring whether or not this market explodes and just blows through, or after it breaks down and goes into consolidation, if now I'm looking at a reversal. As soon as I see a doji, I'm looking at getting out of the market, because if that market closes above the doji, now we're possibly going to have a pullback inside of the box. Now that, again, this market continued to auction lower, but I want to lock in my profits. I'm not interested in trying to hold on for a 100 pip move. I'm looking at, on the euro, if I get 25 pips, I'd be happy. So I would probably have a preset target at 25. In this market, if you were entered in at 43 as your worst fill, you're looking somewhere in the area of 18 as your exit price. The market went down to 08, so you should have easily been able to lock in 25 pips on the euro yesterday. So point emphasizing, regardless of the day, you're in a box. We talked about this yesterday, high-low. They go up, they hit the stops. Engulfment at the high. They go down to the low. A 3-bar consolidation engulfing the low bear pin for the retest of the high. We expand the range on the high side. They come down. They hit stops on traders that are short. We're still inside of the bottom of our initial box on that day. The market pulls back inside in our U.S. session prior to the Fed. They work down into the bottom of the box, bullpen hammer, 1, 2, 3, and an explosive move off. And again, I do not get in front of the news, but there are times when price confirms the opportunity being there. We have our bottom of our box and our shortened W formation. Again, if you're in this trade, there's risks that you could be stopped out with slippage. If they were to gap down, you could get 50 pips as your best, stop fill. But again, this market, this is a 15-minute chart. If you're in this and you're break even, the market exploded north There may have been other earlier opportunities on the 1 minute, but point being, we're talking about the prices in a box, regardless of how the day trades every single day. It could be a trend day. It could be just a normal day. There's our high and our low. They expand the box. They come back inside. They expand the box. They go up to round numbers. They engulf the high. Again, if you're not sure what the engulfments are, look at your charts. Print them off. Engulfment of the high bull stays inside underneath 50 for a fast 50-plus pip move down to the bottom before it engulfs at the low of the day. Engulfing the low bear, pulls back inside, goes into consolidation, and the new day starts. Hopefully you got value from today's video, traders. Keep it as simple as possible. You can duplicate this every single day. There's a high and a low. And there's going to be variations of how this works. You're going to make mistakes. You're going to do things. But that's trading. You cut your losses. And when you get a winner, you squeeze the maximum out that you can. And you finish your session, you move on to the next day, and you focus on doing one more trade as perfectly as possible. Have a great trading session. End the week on a strong note. And may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.